our next guest, says this is a stock picker's market. Investors should avoid the broader averages at all costs. Let's talk markets now with David Bahnsen, Chief Investment Officer of the Bahnsen Group. That sounded really strong, David. I mean, at all costs? So you think maybe you've got some of the same concerns we've expressed here. Valuations are high, and the averages might be considered extended after the last couple of years.
Yeah, I think at all costs sounds a little dramatic. You're right. It is for those that are looking at a short-term situation. I think that the index has valuation concerns, but long-term returns often do matter in terms of your entry point, and the valuations are such that you could have earnings grow 15% next year, which is what they're projected to do. And if the PE just comes down one turn or two turns, you give up that whole return. So we just think it's better to be a bit more price conscious and value conscious.
And David, we could go over probably 5, 6, 7, 8 positive macro developments, like maybe deregulation or an antitrust environment that's much better than what we've had for the past couple of years. But when you throw in all the fiscal spending and all the largesse from the Fed for the last 4 years, it kind of explains why we're at 22 times earnings. And if we've played it forward, there could be some comeuppance to be expected, especially when part of the deregulation might involve DOGE and actually cutting a lot of waste out of the federal government, which, is kind of Keynesian.
Oh, I completely agree, Joe. I think that it's not just 4 years. It's really since the GFC. Since 2008, both fiscal and monetary excess has been substantial. And any unwinding of some of that is an issue. I don't think the Fed will be pulling back. I think, in fact, quantitative tightening is going to end next year. And even if they only cut 2 or 3 times next year, you're still getting a downward trajectory in Fed funds. But to your point, the Keynesian side of this is a future market problem, not a benefit, because at some point it comes out of GDP. The paying back of what we put into GDP via deficit borrowing all these years, it's a downward drag on future growth, and Europe is dealing with it. Japan dealt with it for 30 years.
If you've got a president that gauges his performance or his success on the stock market, what will he do to try to get the stock prices higher? And what will he be prevented from doing that he wants to do to try to get the market to continue to have an upward trajectory?
Well, I'm tempted to answer on what I think he should do, but what he will do is a little tougher. But I can only answer as the Reaganite Republican that I am. He, I think, will be cutting taxes, he will be deregulating, and he will be pursuing energy independence. What I want to say is that the stock market concern will sort of pull back some of the tariff desires, and I'm not sure that's true. I think he will use them as a negotiating tactic, and it may very well end up being effective. Ultimately, if it were to create some of the volatility we saw in 2018, I think that will pull it back. I think this president does care about stock market returns, and certainly the market is assuming that he does. And in 2025, we'll get an idea of how right we are, but it is a bit unconventional. I can call myself a Reaganite. I don't think we're dealing with traditional Reaganite understandings of things right now.
Right. He's not running for re-election. He probably understands that sometimes you need to get the house in order and not get immediate gratification. Do you think he'd have the patience to have maybe a rough start to his presidency, doing the tough things that could pay off in the latter part of the 4 years? Or is he going to need immediate gratification and be, because you can imagine the headlines that are going to be written. Oh, my God, we miss Bidenomics, blah, blah. I mean, you're going to see that written if the market goes down.
Yeah, I think he's prepared for some of it, but I don't think he would be prepared for a longer, run of a downward trajectory on market. But I also don't know that he believes some of these things will be bad for markets. And so if there is enhanced volatility, let's say, around tariff threats, look, Joe, even a free trader like me is not convinced that there will be market pain just by him trying to get to better deals with China. It's when he starts threatening the EU, Mexico, Canada, and even then, he's not doing that right now in the context of protectionism. He's doing it in the context of better support with immigration, crime, drugs, national security. Markets aren't going to revolt at that, and frankly, I think he might get better deals. And so, the things that are probably going to create market pain next year are not because he fails on taxes and deregulation. It'll be things out of his control, like the fact that NVIDIA is trading at 80 times earnings. The president can't control that.
Maybe AI will pay off. None of it, it's early. Remember the internet? I mean, it's unbelievable what it's in every aspect of our life. It's definitely better than a fax machine. Paul Krugman, wrong again. Anyway, David, thank you. Good to see you again and have you on. Hopefully we'll have you on once in a while again.
Love it. Thanks, Joe.
Right.
Happy New Year.
Okay.